Welcome to Investors Guide. Thank you for joining us. I know this seems like a really difficult time. It seems like your savings and your investments are losing value every day, and the stock market just won't stop falling. Which is why we're here this week. What we're going to do this week is we're going to talk to you over the phone. We're going to try and understand what's causing so much anxiety and so many fears among all of our viewers. We're going to try and answer all of those questions. We'll find a way to hold your hand through this very tough time. If you have questions about your portfolio, about anything to do with your money, about the stock market, feel free to write to us. The email ID is at the bottom of your screen, and we're here to answer any questions you might have about your investments. Over the next half hour, in a stock market that seems to be punishing us every day, we'll find out what you should do with your investments. If you're nearing retirement, we'll tell you how you can safeguard your capital, and we'll also find out if gold is still a very good long-term bet for you. But before we tell you what to do with your investments because of what happened in the stock market, we have to first understand what happened in the stock market. There have been a couple of weeks of very, very volatile stock activity, and that, of course, will have an impact on all of our investments, fixed income and equity alike. Let's take a look at how the market has moved over the last 2 weeks and why you and I should be sitting tight with our equity investments. In a bloodbath that began on Friday the 16th last week, the Sensex lost over 690 points until Wednesday, before it recovered to close the week at 18,519. So what went wrong? Why did our stock market bleed out? Analysts are pinning the blame on three main factors. Firstly, a free-falling rupee which has not responded to any of the measures taken by the government or the RBI. Secondly, India's own weak economy and a lack of faith in the government's ability to turn around this bleak situation. And finally, the fear of tightening liquidity across the globe once the US Fed starts withdrawing its quantitative easing program. India is paying for its overdependence on foreign investors, and the more the FIIs pull out their money, the more the rupee devalues. Now, the volatility was not limited to just the stock market. As the RBI attempted to decrease liquidity in the system and FIIs sold out of India, the yield of the 10-year government bond hit a 5-year high and rose to 9.24% on Monday. The government's attempt to shore up the ailing rupee by increasing import duty on gold led to gold prices increasing 8.70% in 10 days. The biggest fear right now is of a sovereign downgrade for India. JP Morgan has already downgraded Indian markets to neutral. Citigroup has cut its Sensex target to 18,900, and Fitch has warned India of a downgrade if the government fails to halt the current slump in investor confidence. It's time for me to bring in Kumar. Now remember, Dhirendra has been giving us advice about our investments for over 4 years now. And at a time like this, we're going to go back to him for the basics. Dhirendra, it does seem like the market is punishing us every day. It seems to get a little worse. The rupee is sliding even further. For those of our viewers who are watching at home, it will seem to them like all of the advice that we've given them over the last 4 years is not working out now, because it's the diversified equity funds that are taking the biggest beating. The debt funds are showing a lot of volatility. This goes against everything you've said over the last 4 years. What should we expect as investors who are looking at this market, who are looking at our long-term retirement money dwindle with every passing day?
I would say that, keep the faith. You don't have a choice. And the other thing is that, what you said, that equity funds are losing ground or they are falling. Of course they have fallen, and, I don't think we can add any meaningful value. But yes, diversification pays. I think most mutual fund investors will be better off. The basic tenets, which is, long-term investing, allocated to equity, invested over time, and so maybe, to some extent you can derive pleasure. If you are investing for next 10 years and, today you are investing, you'll be buying cheap.
I want to ask you a personal question here about your own personal belief. Now, we talk to a lot of people on this channel. A lot of them have not given us too much faith in what the market is going to do. Now, on the long term, if you're telling us that if we don't need the money for the next 10 years, we should not be worried, Are you telling me then, in the long term, for the next 10 years, you still have faith that equity will perform better than all of the other asset classes, that the country's economy will bounce back, that we'll still, find those of us who have invested in equity mutual funds, will still find ourselves in a very good position 10 years down the line? Is that still your belief?
I think so, and I'll tell you why I believe so. My belief rests on one thing. Finally, it's a belief. It's not a guarantee. It is based on very simple hypothesis. That all the things that we were talking about, the India story a couple of years back, that there are a large number of young people and there's a large consuming class, we have a democracy and things will get corrected. And, democracy is a good correcting mechanism to drive growth. If we have basic things available, if we are able to restore a little bit of economic confidence, then I think equity will do well. Right now, the market has taken a stand that all our companies are going bankrupt, and there are few companies which are making a lot of money, and the market is willing to pay any price for those. So the market is extremely polarized. And but that is never this phase of market does not last very long.
But, Virendra, like I told you, we have several viewers who are very concerned about their investments, and one of them is on the phone with us right now. I believe it's Vishal who's on the phone. Vishal, thank you for calling in. Can you tell us what your question is and how we can help you?
I just wanted to know that I'm just 25. Tomorrow I'm getting married. I have kids, their future. So in what area should I put my money in? In equity, debt, or in any other format?
Vishal, if I may ask you, is there any reason why you're doubting equity at this point at your age? Do you believe that maybe the market won't be able to give you good return?
Equity is not performing as it should have been. Only in 2009 it had been grown up. But from then and there, it has been depreciating and depreciating.
Virendra, this is obviously a question that a lot of our viewers are asking. Like we talked about a little earlier, it's already been 5 years. We haven't seen equity do what it was meant to do, which is beat inflation in the long term and give us a return that's better than the fixed deposits. And maybe young people like Vishal across the country right now are asking why they should look at equity at all. Won't a fixed deposit do the job for them?
So by its design, equity is supposed to deliver superior return over a period of time. Yes, these 5 years, and anybody who has been in the market has every reason to be disappointed. But I think it is a matter of why you should have faith. The other is that, businesses don't disappear. We are thinking as if, tomorrow we don't need anything, businesses don't need to exist, and everything will go down the drain, nobody will ever make any money. That is unlikely to be the case. We have competent businesses, and, they'll make a comeback, they will navigate through these times, and some businesses will fall by the wayside.
Vishal, I want to ask you, if you're 25 years old and you're investing money right now, for how long are you going to put that money away? When do you expect to need the money that you're investing right now? That will give us a better idea to be able to give you some advice.
At least 25 years I have to be in equity to build a corpus.
All right. So that's good to hear. 25 years there from Vishal. Virendra, would you like him to use our aggressive portfolio? Is this a good time then for young people to get in aggressively at equity and start buying and start investing today? Start an SIP perhaps?
Absolutely. I would say that, he should go for our aggressive portfolio, maybe drop one or two diversified, more moderate funds from that. And I'm hopeful that, if somebody is investing through these periods, the market, when there is absolutely no belief in the market, when the markets are crumbling, those are the investments which prove to be, the most profitable ones. And I would urge a lot of our investors, a lot of our viewers to not watch the investment values on a daily basis. That causes a great deal of anxiety. Maybe, just look at, just change your frequency of viewing the worth of your portfolio at least every week. If you're doing it daily, go on a monthly cycle if you're doing it every week.
All right, we're going to send you a list of funds. And remember, Vishal, this show is here every week. You can always get in touch with us if at any point over the next 5 years you continue to be nervous We're here to answer your questions for you. Someone from our team will get in touch with you and send you a copy of the advice that Dhirendra has given you. Remember, if you would like to get in touch with us, email ID is at the bottom of your screen. Dhirendra, that was a very young person. Right now, we have Mr. Fernandez on the phone. Now, he's a retired person and he's very concerned about the volatility that he's seen in both debt and in equity, and he's particularly concerned about his monthly income plans. And this is important because you personally have recommended on this show that retired people use MIPs to generate that monthly income. Let's bring in Mr. Fernandez. Can you hear us? Would you like to tell us what your question is?
Good evening, Ms. Faye and Mr. Kumar.
Good evening.
Good evening.
I have invested 35% of my corpus in bank fixed deposits, 30% in fixed mutual funds comprising of large cap balance and MIP, 5% in PPF and insurance, and the remaining 30% is lying in liquid funds, which I now consider investing in FMP. This was really meant to be invested in MIP. But seeing the MIP NAV is going down every day, I'm a bit concerned about this investment. Could you guide me, please?
Just to put this in context for all of our viewers, an MIP will a portion of which is invested in equity. So about 20% of an MIP is in equity. The remaining 80% gets invested in fixed income. And of course, he's considering instead a fixed maturity plan, which according to a lot of viewers doesn't have mark-to-market risk. So there might be a lot of people considering this question right now. And Mr. Fernandez thankfully has brought that forward. What would you recommend he does?
I think, if Mr. Fernandez is going, if you are going to depend on your investment for regular income, you are going to, you need the income from your investments every month, then by all means, you have done the right things anyway. You have a third of your money into bank fixed deposit. I don't know if you're getting a monthly income from that, monthly interest payment from that, but MIP may not be, and if that is the case, then MIP rightly should not be is not a reliable vehicle for you to derive monthly income, though they are called MIPs, because you can't really bank on this. And I'm also extremely disappointed by the MIPs. One is that many of these fund managers have been grossly indisciplined with their allocation, and they don't keep it constant. And otherwise, I feel that these funds have been not fair to investors in a sense that 80-85% of the money is in fixed income, only 15% of the money is into equity, and the expenses charged are nearly 2%, and sometimes mostly more. So when I compare it with what investors are levied or charged for their fixed income investment, this proves to be, this is a fund which has not delivered as much as bank, post office, MIP or anything. My suggestion will be that go for a SMP which is conservatively run, has lower expenses, and don't get carried by exaggerated very high return expectation or return pointers.
Go ahead. You have another question?
Yes. How will I know which FMPs are good? As Mr. Kumar said, choose good quality FMPs.
Well, Dhirendra, of the FMPs that are coming out in the market right now, and there are so many being floated because of the interest in FMPs, how would any investor rate an FMP and decide whether or not this is a good one?
One is that, look at the offer document. You will get and every FMP, that is being offered, it carries the information about all the older FMPs that have matured and the ones which are in currency. Check in the offer document how much of a corporate debt exposure the fund is going to take. And once you look at the precedence of the background of the fund company and the way it has redeemed its FMPs and how much of return and how much of what has been its track record, and there are fund companies which have their background. You will get all this information on our website as well.
Mr. Fernandez, we hope that helps. Do you have any more questions?
No, thank you so much, Faye and Mr. Kumar. Thank you.
Coming up after the break, we're going to talk to more viewers, and Dhirendra will tell you how you should safeguard your money if you're nearing retirement. We'll also talk about gold and find out what's behind that interesting price rise we saw last week. Don't go anywhere. Welcome back to Watching Investors Guide on ET Now. Dhirendra Kumar is still with us. What we're trying to do this week is answer as many questions as we can and talk to as many of our viewers as we can in a difficult market. On the phone right now is Pradeep Shinte. I believe he's nearing retirement and he's a little worried about the volatility in the markets and what they'll do to his capital. Mr. Shinte, what's your question?
Well, I'm 60. I probably will work another 2 years. I have a very moderate risk appetite, and in this volatile market, I don't know where to park my money. I have been doing basically being safe and putting the money in fixed deposits. I have shared my portfolio, but going forward, I have a horizon of another 18 to 20 months where I can save about 3 lakh rupees a month. So I would like to understand how to invest that money so that in this bad time I don't lose and I earn more than what fixed deposit gives me.
Yeah, I would suggest that, he should retain his investment in Axis Triple Advantage, HDFC Balanced and ICICI Pru Balanced. These are more stable vehicles than most other, any other equity fund that he will own. And his incremental investment should also go into these three. And but on a broad scale, on a broad basis, you have to really worry about your income requirements when you retire. And this is not a portfolio from where you can derive your income.
All right, Mr. Shinte, you can get back in touch with us if you have any more questions about your money. If you have questions for Kumar, write to us. Email ID is at the bottom of your screen. We have an email that's coming from Naveen. He hasn't told us how old he is, but he's put all of his money into deposits in nationalized banks. He tells us they're giving him an interest of 9.5% right now, and he seems to be fairly proud of his option. He wants to know if there's a better option out there.
No, I think if he is not a taxpayer, if he does not fall into a tax bracket, and if he cannot assume any risk, and this investment, the money in fixed deposit, he can lay his hands on any time, or that is a requirement, then I think he has done a brilliant job. But if this investment is, he's unlikely to need this money for next 10-15 years. If it is a very long-term investment, this 9.5% looks very impressive. And if he is a taxpayer, if he's in the highest tax bracket or 20% tax bracket, he should look at, his post-tax return. In a very conservative way, he can do a little better by if he's a taxpayer, then he will be little better off by not assuming any significant risk and moving into FMPs. FMPs are like the fund version of a fixed deposit. They are fixed maturity plans. You get logged in for a term. You cannot lay your hands, unlike fixed deposit, you cannot withdraw your money from that. And you get a predictable return. And the return that you get from FMP, which have a term of over 365 days, can be more tax efficient. You just pay the capital gains tax. So there could be a straight 20% differential on that if you are in the highest tax bracket.
All right, so the learning here is that if you have long-term investments to put away, equity should still be your option. We still have faith in equity in the long term. Now, the other asset class that we must talk about that's gained a lot of attention over the last 2 weeks is gold. Now, we saw gold prices move up very sharply from about 28,000 rupees per 10 grams, which they were at, to 31,000 rupees per 10 grams last week. Now, while we can take some solace in the fact that gold is the only asset class that's performed well for us as retail investors, and we bring in Naveen Mathur of the Angel Broking to help us understand what's causing that rise in prices and how long he expects it to stay strong. Well, Naveen, thank you so much for joining us on Investors Guide. Tell us, first of all, if you can, the reasons for the recent rise in gold prices.
Talking about the domestic markets, we have seen some kind of curbs coming on to rein in the current account deficit on the gold imports. And therefore, from 8% to 10% is what the import duty has been imposed in the last couple of days, increase the landed cost of gold by 600 rupees per 10 grams approximately. Now, what is that particular reason? The second reason is definitely the depreciation in the Indian rupee. The depreciative rupee adds up to a pressure for the prices to be upside in Indian rupee terms, and therefore we have seen the prices moving on the upward trajectory. The last and the foremost is that with these curbs happening in India due to these import duty restrictions and import restrictions, the supply concerns have started to be talked about. The demand would be good, the rural income would be good this time because of the monsoon being pretty healthy, and the festival season coming in India is also therefore look forward to have a good demand. And therefore with supply shortage may be expected because of these curbs, and the demand being on the high side, the sentiments also are driving prices in Indian markets to be on the upward trajectory.
So, Naveen, what does this mean then for those of us who are considering buying gold for the long term? And a lot of times retail investors want to buy gold because they're planning for a wedding, maybe 2 years down the line, 3 years down the line. What's your view on gold? By the end of the festive and the wedding season, where do you expect the price of gold to be domestically?
Okay, now the price in Indian market looks to be on the upside from here. We are expecting prices to be touching at around 31,000 levels or 31,500 levels by the year end. And the expectation is only and only because of the continuous stance on the rupee depreciation against the US dollar. Overall, with a range territory on international markets from 1360 to 1410 levels in dollar prices, Indian market looks to be at around 29 to 31,500 range in near term. But by year end, I expect around 31,500 levels to be there in Indian markets for gold for 10 grams.
In that case, then, is it a good idea for retail investors to buy gold at these levels, or would you prefer it if we wait for the prices to come down?
Depends upon. If you are a long-term investor, I think the buying can happen at around 28,000, 28,500 levels for a long-term gains.
All right, Naveen, they're telling us to hang on and buy gold only when the prices do come down, and it makes sense, like all other investments, to stagger your purchase, whether it's in equity or in gold. Time for a very quick break. On the other side, Virendra is going to stay with us, and we'll talk to more viewers. We'll find out if you should be redeeming your bond funds to pay off your home loans. Don't go anywhere. Welcome back to watching Investors Guide at ET Now. Thank you for staying with us. We're trying to speak to as many of our viewers as we can this week to answer some of their questions given where the market has been over the last couple of weeks. I believe we have one more phoner on the line. Vipul is online with us. Vipul, hi, thank you for calling in. Tell us what your question is.
I had a question to Dhiren, and it was, I have got investments of 2.5 lakhs in HDFC MIP, aggressive plan. And will it be the right time, seeing the bond market crash, to take out the money from the fund and do a partial payment of my home loan?
All right, that's a very good question, Vipul. Thank you for calling in. Virendra, for all of our viewers who are asking this question right now, home loan rates are on their way higher. They might go up a little past 10.5%. Is there any investment right now that we should keep running while we have a home loan running side by side? Does it make sense, like Vipul wants to pull the money out of his MIP and use it to pay off his home loan?
It always makes sense. I have always suggested over time that never borrow to invest. And this effectively amounts to that, because if you look at your own finances, on one hand you are borrowing money to buy your house. On the other hand, you have your investments, which are not earning as much. So this effectively indirectly amounts to, borrowing to invest. So you should clear it up as much as possible. It may not look very opportune, or there will be a psychological barrier if you invested and, your MIP has not done very well, or if you're in losses. But I think, going by the way the interest rate on your home loan will go up, it makes sense, and it will also give you peace of mind. And the moment you are through with your home loan, and if it can either reduce your EMI liability on a month-on-month basis, as and when you are able to save more to start your SIP again.
Okay, Vipul, so it does make sense then to break your bond funds and, of course, your fixed deposits, if you have any, and use them to pay off your loan, bring down that burden. Of course, at 10.5% or 10% interest rate, none of your bond funds or fixed deposits are going to be giving you that kind of return. So it doesn't make sense then to be keeping any money in deposits at all. Now, if you have questions for Dhirendra, remember you can write to us. Email ID is at the bottom of your screen. Send in any question you might have. You'll find a copy of this show on our Facebook page, and you can reach me personally on Twitter. Dhirendra, thank you so much for spending time with us this week. Next week, of course, we'll take a look at all of the portfolios designed on Investors Guide. We'll see how they're doing and how you are doing then as investors. Thanks for watching.